Welcome to the Pro Ticker Deep Dive. Today, we're tackling one of the most critical forces really driving global markets right now, and that's systematic flows. For a long time, we all focused on earnings reports, unemployment data, Fed statements. And while those are still foundational, the reality is that these powerful rules-based trading algorithms are, well, they're increasingly dominating the daily price action. So this deep dive is all about mapping those colossal financial flows. We're talking specifically about commodity trading advisors, volatility control funds, and the options hedging activity we call dealer gamma. Our mission here is to uncover why the market feels so incredibly stable, almost quiet, even as it's hitting record highs, and critically, where the specific technical tripwires are that could trigger massive, lightning-fast selling or buying.
And that's the key theme, right? That potential for stability masking a deep fragility. We're looking at three huge groups that act as, well, massive mechanical accelerators or brakes on the market. First, you've got the CTAs, commodity trading advisors. These are sophisticated trend-following funds.
Yep.
I mean, they're designed to ride existing trends, and right now, they're holding sizable long positions. They're basically surfing this bull run. Second are the volatility control funds. These strategies are extremely focused. They adjust their equity allocation based purely on realized market volatility. When things are calm, they buy more.
And when things get choppy?
They're forced to sell. Simple as
Yep.
that.
And the third one.
And third, we have dealer gamma. This is the hedging from options market makers. In this current environment, with the index so high, it's acting as a massive stabilizing force. It's like an anchor holding the market steady.
Okay, let's unpack this. The picture that emerges from the data is a market that's full but fragile. So let's start with those trend followers, the CTAs. Where exactly is their positioning, and why does this word stretched keep popping up?
They are absolutely stretched. And really, that's a measure of risk tolerance. The long positioning you see across U.S., European, and even Japanese equities, it reflects a deep conviction in this multi-year bull trend. If you look at the Deutsche Bank data, CTA equity positioning recently hit extreme levels. We're talking the 90th percentile, historically.
The 90th percentile.
Yeah.
So for everyone listening, that means out of the last 10 years, they've only been this exposed to stocks for, what, about 1 year total?
Exactly. It means they have very, very little comfortable room left to add more risk. They did trim a little bit in late 2025, but they've only come down to about the 75th percentile.
So still very long.
Oh, yeah. Significantly long stocks, which just means they are highly exposed if or when the trend reverses. They are quite literally riding the trend.
And it's not just stocks, which is, an important point when we think about forced selling across assets.
That's right. They're adding risk wherever an uptrend exists. So after that bond rally late last year, CTAs were also net long U.S. Treasury futures, both the 10-year and the 30-year. This kind of universal bullishness means that if global volatility were to spike, there's a real risk they might be forced to cut exposure across everything at once, not just equities.
Okay, now let's shift to the vol control funds. These are the strategies that, well, they really thrived on the low volatility last year, and they injected billions into the market. It sounds like they're pretty much at max capacity now.
They are fully loaded. That's the full part of our full but fragile thesis. The mechanism is simple, but it's incredibly powerful. They have a target volatility budget,
Right.
So as realized volatility, that's how much the market actually moves day to day.
Yep.
As that fell to historic lows, these funds just mechanically bought more equities to stay on target.
Can you give us a sense of the scale here? I mean, what kind of mechanical demand are we talking about?
The scale is staggering. I saw one analysis that noted in mid-2025 alone, just during one low vol crunch, these funds put an estimated $132 billion into equities.
Wow, $132 billion.
Yeah. Think of that as a huge systematic bid that cushioned every single minor dip and just ensured the index kept grinding higher. It's almost impossible for discretionary traders to fight that kind of flow.
But if they've bought that much, where does the fragile part come in?
The fragility comes from the reversal. By late 2025, their allocations were near the very top of their historical range. They have, and I'm quoting here, little additional buying capacity, unless vol drops even further.
So they're out of ammo.
Basically. And it implies this massive latent supply overhang. If volatility, the realized vol they track, starts to creep back up, they must sell to stick to their mandate.
Which brings us perfectly to the third piece, the stabilizer. Options dealer gamma. Right now, this is what makes the market feel so anchored near these all-time highs as we get closer to, say, 7,000 on the S&P. What does positive gamma actually mean for day-to-day trading?
It means the dealers are a powerful stabilizing force, a buffer. In this high trading range we're in, options positioning means dealers are sitting on substantial positive gamma. So, to clarify how that works, positive gamma means that when market makers hedge, they're forced to do the opposite of the market's direction.
So they lean against the trend.
Precisely. When the market rallies, their risk changes, and they have to sell futures into the rally to stay neutral. If the market dips, they have to buy futures into the dip.
Okay, so if the market tries to run up, dealers sell. If it tries to drop, dealers buy. That explains exactly why we've had this tedious, grinding, low volatility climb. It feels like hitting a dense wall every time the market tries to make a real move.
That's it exactly. And this stabilization is anchored around key S&P strikes, like 6,900 to 7,000.
Yeah.
We also see huge open interest at those big round numbers, 5,000, 6,000, 7,000. For now, dealers are your best friend if you like stability.
For now. That's the calm picture. But here's where it gets really interesting. This calm is conditional. The sources show there are specific technical levels, these tripwires, that could instantly turn these stabilizers into amplifiers of a sell-off. Let's start with the CTA triggers, the price levels that force their hand.
Right. Because they're rule-based, we can actually predict their actions. The key is understanding there are two different lines in the sand. According to analysis from UBS, the first halt, where they just stop buying, is the S&P 500 at around 6,925.
So below that level, the systematic bid just disappears. They stop adding fuel.
Correct. That's bad, but it doesn't trigger a crash. The major downside risk, the big inflection point where they go from standing still to actively selling, that's lower.
And what's that level?
That critical threshold is S&P 500 at around 6,500. This stands out as the major inflection for the medium-term models. If 6,500 breaks, CTAs start unwinding those mats of longs we talked about. They could even flip outright short.
And Citadel's research points to a similar zone, right?
Yes, they've identified that same area as the big medium-term threshold where significant risk has to be cut.
Given how stretched they are, the size of that selling must be enormous.
It is. A break of 6,500 could trigger systematic selling on the order of double-digit billions of dollars in equity futures. And this isn't just a U.S. issue. You have similar tripwires globally. The Euro Stoxx 50 is around 5,600.
So once those levels break,
CTAs shift from being market dampeners to becoming massive volatility amplifiers. They reinforce the downdraft.
okay, so CPAs give us price triggers, but the vol control funds are driven by something else entirely, volatility itself. How does that tripwire work? Why is it so dangerous?
This trigger it's a powerful but lagged feedback loop. It's driven by realized volatility measured over, say, 20 to 90 days. Their mandate is to maintain a fixed portfolio volatility.
Right.
So if realized vol spikes, if the market is suddenly moving 1–2% a day instead of 0.3%, they have instantly overshot their risk target. They have to cut equity exposure to get back in line. The trigger to watch for here is a sustained move of 1 month realized vol, or maybe the VIX, up into that 20 to 25% zone. That's much higher than where we are now, and reaching it would force them to deleverage in a big way.
And what's the potential damage? I mean, if that $132 billion of buying is forced to reverse?
The magnitude can easily rival the CTA flows. I mean, estimates suggest a vol surge into that range could force something like 60+ billion of equity selling over just a few days. This is the classic elevator down risk.
They go up by the stairs and down by the elevator.
Exactly. They build positions slowly in the calm, but the rules force them to unwind all at once when vol spikes. It's the speed of that exit that scares people.
It really is. Okay, finally, let's go back to the dealers. They're stabilizing us now, but that's conditional. Where's the dealer gamma flip point? What happens when they flip?
Their stability is purely conditional, you're right. We're in positive gamma territory now. But if the S&P sells off through, say, roughly 6,850, that's the first line of defense, on its way toward that critical 6,500 CTA level, dealers could flip into short gamma territory.
And once they're short gamma?
Their hedging flows completely reverse. They stop being a buffer. They now have to buy futures when the market rallies, and crucially, they must sell futures as the market falls.
So they start chasing the move.
They reinforce it. They pour gasoline on the fire. It creates this reflexive feedback loop where their selling forces more selling.
And that's where the real panic can set in, when all three systems, CTAs, vol control, and dealers, are all selling at the same time. But this can work on the upside too, right? A melt-up is also possible.
Absolutely. If the S&P were to rally explosively above 7,000, breaking that huge wall of call options, dealers who are short those calls would suddenly get caught short gamma to the upside.
Meaning they'd have to buy.
They'd be forced to buy futures to hedge, which causes an accelerating melt-up, what they call a gamma squeeze. These levels where gamma flips from positive to negative are the exact points where the market's own structure amplifies momentum.
So this whole systematic structure really dictates the market's behavior at the extremes. Okay, what does this all mean for the next, say, 1 to 3 months? Let's run through the 4 potential paths forward.
We can start with the base case, scenario 1, controlled grind higher. This is basically the path we're on now. The conditions are simple. S&P holds above that 6925 CTA level and volatility stays low.
And the flows stay supportive.
Right. CTAs add a little on strength, bull control funds stay fully invested, and dealer gamma just contains the swings. The result is a stable, gradually rising market. Frustrating maybe, but profitable for bulls.
Okay. Then we have the big risk. Scenario 2, the downside break and reflexive unwind. The black box risk.
This is the bearish inflection. It happens if some negative catalyst, a bad inflation print, a geopolitical event, causes the S&P to fall through 6925 and accelerate down towards 6500.
In that scenario, all three forces would align against the market.
Perfectly. CTAs flipped a massive selling. The sudden price drop causes volatility to spike, forcing that $50 to $100 billion in vol control deleveraging. And then dealers flip to short gamma below 6850 and start selling into the decline.
Sounds like a lightning-fast event.
It would be. The impact is a swift, sharp correction that overshoots fundamentals. S&P could quickly drop towards 6,200 or even 6,000. It's the classic air pocket where liquidity just vanishes.
Okay, what about a middle ground? Scenario 3, the frustrating chopper, where the market gets messy but doesn't fully crash.
This happens if realized vol-in just rises into the 20s because of choppy trading, but there's no clear trend break to trigger the full CTA reversal.
So the vol control funds would be the main sellers then?
Exactly. They would be forced to slowly trim their exposure, creating this steady headwind that caps any rally attempts. The result is just prolonged consolidation or a mild correction, maybe 5 to 10%. Death by 1,000 cuts. It frustrates everyone.
And finally, the quick upside risk. Scenario 4, the melt-up.
Right. If the S&P rips explosively above that 7,000 call wall, dealers flip short gamma to the upside and are forced to buy futures as the market rises. CTAs are already fully invested, so there's no selling pressure.
And the rally just feeds on itself.
It does. The impact is a powerful, explosive surge, maybe 5–10% in a really short window, pushing us towards 7,500 or higher. It's a crucial reminder that these flows can cut both ways.
We've mapped out the flows, the positioning, the risks. For our listeners, what should be the main strategic takeaway from all this?
The primary takeaway is the severe fragility hidden inside what looks like stability. This full but fragile positioning means you should probably be keeping some protective hedges in place, even with all the bullish momentum.
Like protective puts.
Exactly. You have to recognize that an orderly market can become disorderly very, very quickly when these key thresholds break, purely because the systematic support just vanishes and then reverses into selling pressure.
So the key is really turning these metrics into actionable intelligence by watching those specific levels.
That's it. You have to track S&P 6,925, the level where buying stops, and 6,500, the flip short level. Knowing this helps you understand why the market is moving. If you see a sudden 3% drop, you'll know it likely hit a CTA stop out. The move is mechanical, and it might overshoot, but it could also stabilize once those flows are done.
And we have to remember the cross-asset risk. If CTAs are long treasuries and stocks, everything could get sold at once.
Correct. When volatility surges, diversification often disappears. And since derivatives are such a huge part of this, it's better to buy protection when vol is low, before the VIX spike hits. Oh, and keep an eye on options expiry dates, OPEX, because that can release pinned gamma and lead to bursts of volatility.
The ultimate message seems pretty clear then. Systematic flows aren't a footnote anymore. They're a key part of the market ecosystem, right up there with earnings, economic data, and the Fed.
Absolutely. The market is being held up by this strong positioning, but the key risks are all mapped out. Vigilance is crucial. And here's a provocative thought to leave you with. The current structure means that these technical price levels are often self-fulfilling prophecies. The moment 6,500 is breached, the market knows the mechanical selling from CTAs and vol control funds will accelerate,
Which causes other traders to sell preemptively.
making the breakdown even swifter and more devastating. They try to get out before the big wave hits.
See you all in the next Pro Ticker Deep Dive.